Hey everybody, are you paying too much to trade options? Well, if you're not on public.com, the answer is yes. Public is the only platform where you earn a rebate on every option contract traded, and that's in addition to no commissions or per contract fees. There's no one else out there paying trading rebates, so you won't find a better deal. Bottom line is, if you're paying more than $0 to place an options trade, then you're paying too much. Switch to public and start getting rebates on every single contract traded, only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description.
Welcome, everybody. Welcome to First Friday. And of course, it is not the first Friday. And this is not the first time. It was not the first Friday when we were doing the live stream. I'm Jason Hall. He's Jeff Santoro. Everything I said was accurate, right? Right, Jeff?
Yeah, it's the first Friday when it is the first Friday, and it's not when it's not. That's the best way to describe it, I think.
That's it. Just 2 months in a row. 2 months in a row that
It might be, actually, it's going to be 3. I think August is going to have to be the week after, too. Listen, I'm not rearranging my life or my vacation plans for an arbitrary date that we chose without any thinking months ago.
I offered to do the live stream when I was on my vacation. I did. I made that offer. It was an empty offer.
Yeah, I don't think that would have gone well for your marriage.
Probably.
Probably not.
Probably, yeah. Yeah, no, I think that's fair. So, all right, what do we got lined up for talk about today?
We have a lot of stuff on the agenda here. I think the thing that would be fun to start with, and hopefully as some people come on and join us, they'll chime in as well. So today is I guess what most people consider to be the kickoff to earnings season. Whenever it's the Friday that the big banks report, that's when I think a lot of people kind of view as the trickle, the slow beginning into earnings season. So in the next week and 2 weeks and 3 weeks, we're going to get tons and tons and tons of the companies that you and I follow, Jason, and I'm sure a lot of our listeners and YouTube viewers here follow as well, are going to start reporting results. And I don't know about you, but this is my favorite 4 times a year because we finally get an insight into the companies, and there is nothing more boring than like the 2 weeks before earnings results. It's like, it feels like there's no news, nothing to talk about. So let's talk about earnings. I have a question I want to ask you about today, but I'll save that for a little bit later. I'm curious, as you look into earnings season, are there any companies that you are particularly interested in hearing from?
Yeah, I've been thinking about this, and I've decided to turn my investing brain back on. I left it off when I was on vacation, and I really didn't turn it back on until probably Wednesday. And there's a lot of companies that, and we'll talk more about this as we kind of go through the next hour. There's a lot of companies that I like to kind of look at their earnings just to kind of find out if there's any tidbits about what's going on with the economy broadly. Give me some ideas about what's happening in certain industries. And today was kind of the big kickoff with banks. JP Morgan reported, Wells Fargo reported, and Bank of New York, and maybe one of the other big banks. I can't remember. Capital One, maybe. Can't
I know
remember.
Citi reports, Wells Fargo.
Citi. Yeah,
Citi's
Citi, Wells, and JP Morgan today. Monday, I think, is B of A.
Yeah, they're Bank of America is usually the week after. Yeah,
and those to me, they're always really interesting to follow, because you do kind of get some little interesting pieces of information about what's going on with the economy broadly, because those banks are so connected to so many Americans and so many American businesses. I don't think that information is necessarily useful, but I think it's interesting.
yeah. It's funny. When we were planning for the show, you had put onto the outline. You asked the question: what companies do you not own that you still kind of follow the earnings of to get information? And I wrote none, because I don't, in the sense that like I don't do anything near the amount of work I do for the companies I do own. I think the way I follow those types of things, like bank earnings and the bellwether reports that sort of give you an indication of where things are headed, I do that just through kind of the headlines that come through financial media. Like, you can't be a person interested in investing this week and not know how the big banks did, at least at the high level.
Right.
And then if I owned any of them, I would obviously dig in a little bit more. To me, it's like I feel I'm less interested in any individual bank's results as I am looking at them in totality, because like any individual and the banks are all not the same, So for example, you know, if a bank has a big part of their business that is helping companies IPO, right, and big investment management part of the business, then they're going to have a different quarter than a bank that has a lot of just consumer deposits.
Yeah.
So I don't think there's too much to read into any individual report. I just kind of think about them as a monolith in terms of maybe any indicators for the economy. Were there any
Yeah.
headlines that came out today? I haven't looked yet about today's earnings. Did you see
I haven't
anything
either.
today that was notable?
I haven't looked. I really, I really haven't. And but yeah, that's typical of me, unless like I'm doing something very specific for like the work part of what I do. I'm generally pretty slow to really start digging into earnings. And it's actually one of the ways like I try to trick my brain to not put too much importance on any one particularly quarterly period, you know?
Yeah.
I mean, it's 90 days plus or minus a few days of financial results. So I tend to be really slow to review it, except for the companies that I'm like really interested in what they're doing, or like I'm really, really looking for them to fix something, right? Then I might look at it more quickly because I really want to see evidence that whatever they're trying to do is working, or be ready just to move on, you know?
Yeah, I definitely do that for the ones I own. Like there are, and we'll talk about that, there are particular companies that I'm very interested in seeing what they're going to do. Um, all right, I have a question for you though. So I am, I've had this hot take for a while, and I don't know if you agree with me. And we don't have a lot of people viewing live right now, but I'd be curious if anyone is on there or wants to comment on this. You hear a lot about the guys who come on to financial media and are kind of always doom and gloom. There's the recession around the corner. This indicator means that this is going in the wrong direction. Things are going to get bad. And then you usually see the rational people in the financial world saying like, "Oh, this guy, what's the phrase? This guy's called, 40 out of the last 3 recessions."
Right,
Um,
right, right.
but someone who does that, I think, and it feels to me just anecdotally without me like going back to look, is always wrong, or at least mostly wrong. But everyone still trips over themselves to compliment this guy,
Hmm.
is Jamie Dimon.
Oh, wow.
So I went back today. I did actually Googled like what I Googled what did Jamie Dimon say today, and then I hit the news button and I just went back through some old articles. And pretty much any article you can find is a headline of like him warning about a recession, or saying, using some analogy, there's stormy weather coming, there's going to be a whatever, a tsunami of this or a hurricane of that. And
Yeah.
I
Yeah.
he's been doing it for as long as I've been paying attention to the stock market, which is 4 years. So I'm cognizant of it just in the last couple of years. And the most recent one I found that was very overt was from the end of 2023. And it was like Jamie Dimon warns of recession, warns to be ready for recession. And I guess
Right.
if you say that with no timeline, sure. Like right now, I, Jeff Santoro, on this podcast, warn all the viewers and listeners that there will be a recession. And I just don't give a date. I guess that's
That's all.
fine.
That's
I don't
all.
know. Is it me, or I just feel like he's always out there with these hot takes and they're usually wrong and no one ever calls him on it. I don't know. Maybe I'm wrong.
I'm gonna push back a little bit because, well, first of all, you're right. He has been making some calls. I think there's also a little bit of context that gets lost in what gets reported about what he says, that maybe the way it gets framed isn't really fair for what he's trying to convey. But he has really for 3 years now been pretty definitely the past 2 years, 2 and a half, close to probably 3 years at this point, been leaning very much towards the idea of recession, and probably a relatively painful one. And he's been wrong about that. But you know what? You know who you want to manage their business based on the risk of a recession? the guy running the biggest bank in the United States, you know?
And yes, that's fine. This is not, I'm not knocking him as a
Yeah.
CEO. I'm not knocking him as a knowledgeable leader of banks. I mean, I think when we had, I forget if it was offline or online with when we talked to John Maxfield a long time ago. I mean, he basically said that Jamie Dimon was a genius savant.
Mhm.
And I trust John's opinion on it. I'm not saying anything about that. It just feels like he's constantly out there with like bad news predictions that have not come true. And no one ever seems to call him on it. So that's all. I just thought that was it. Because we're talking about banks, it
Yeah.
popped into my head.
The difference, though, he's not one of those perma bears that's spent the past 15 years living off of getting the financial crisis right. And that's it. That's their entire shtick, right? They shorted some stuff and made money. Michael Burry, for example, is one that, um, that's his legacy was he got that right, made a ton of money, and didn't necessarily do well with anything else. So,
Yeah. But I mean,
Jamie Dimon has built the biggest bank in the history of the world. So
it is interesting though. Like, I know another one of the things that we have on our list of topics here is to talk about if there is going to be a recession and when we might think there's going to be a recession. And I was thinking about this, and I'm of two minds of it. So one is the last time I thought the market was like really excited and frothy and overvalued in some places was right before there was a recession. And it kind of feels a little bit like 2021 again. Like we're looking at another really good start to the year. We've already had more than the average year's worth of gains in the first half of this year.
mhm.
Um, so like, yes, I guess at any point things could turn around. But what's interesting to me is now it looks more than ever that there's going to be a rate cut at some point this year, right? Like the inflation, another good inflation report. And whether there is or
What
not,
wasn't the print still 3%?
yeah, but it was
Low. That's
yeah, but it was a slowdown, right?
yeah.
Look, I wouldn't
Yeah.
be surprised if there isn't one, but I guess, all right, let me rephrase. What happened this week was not something that made me think that it was less likely that we're going to have one. I
Right.
think it's as likely as it was before, or maybe a little bit more likely. But all the jobs numbers are still okay, slowing a little bit. Um, but I don't know. It's like maybe it's just I don't think about when there's going to be a recession much. I don't really worry about it. Um, but it just seems like it's the thing everyone wants to talk about. I guess it drives clicks. I don't thi- What do you?
Yeah.
I mean, do you have any predictions or hot takes or sense of like when and if we might? I mean, if it's not a thing, there will be one. But do you have any sense of?
What do I always say about recession? What do I always say about it?
I don't listen to most of what you say.
That's probably the best starting point for everybody with me. I say I always expect one. Like I always think there's going to be a recession within the next year, but I don't plan and invest accordingly.
Yeah. Yeah.
So I do plan accordingly to some extent. Things like emergency savings, right? Because that's money that you might need in the very short term. But I don't invest for the long term based on expecting that recession to happen because guess what? You're wrong most of the time if that's what you think is going to happen.
Yeah. I think that's important. I mean,
Yeah.
you
Yeah.
have to always be planning for a recession. I mean, like that's the reason you have an emergency fund,
Exactly.
right? Like you want whatever you want. We want 3, 6, 12 months worth of your necessary expenses saved so that if there is a really bad recession and you and or your partner, spouse, significant other loses their job, you want to be able to get by, right? So in that sense, you should always be ready for one. I agree with you. But yeah, I've never made an investing decision based on like, oh, I think it's happening soon. And I do know people who do that. People make comments like, it's gonna be a recession soon. I sold a bunch of stocks. And it's like, okay. Um, although I do think it's probably wise if you're the kind of person that's gonna want to put cash to work during a recession to maybe keep some cash on the side and you're investing cash on the side to be able to take advantage of that. Like that was something I wish I had thought of in 2022 when everything went down. All right. So let's circle back to the earnings discussion because you talked about how you look at the banks at the beginning of the earnings season to sort of get a sense of where things are headed. Do you have any specific companies in your portfolio or even on your watch list that you're very much looking forward to hearing from?
Yeah, I mean, I know there's one that you and I both share in common. That's CrowdStrike. I'll let you talk about CrowdStrike, but um, there's the kind of cadence of a few that were darlings when they went public, but just have really struggled to deliver results that I still see potential in their business model and they've shown some progress. Lemonade, for example, I think has shown some progress. Their underwriting looks like it's gotten better. The growth is slowed a little, but it's still pretty strong growth. Um, they need to start like creating more book value, um, and getting those loss ratios down even more. Um, but I do think there's signs that they're doing that. Upstart's one too that I continue to like. I will probably read their earnings report the day that it comes out, and I usually don't read the same day, because they keep adding more and more banks and credit union partners. But just that the whole market for personal loans right now is so weak, because interest rates are up. And they've been slow. They're slowly expanding into like HELOCs and auto lending and stuff like that. Those things are still just a tiny part of their mix. But I really think that business has so much potential because of the number of banks that have said, sure, we're going to partner with you. And banks, they can't screw up underwriting, especially for the highest risk kind of debt, that unsecured debt. So that's another one that I follow pretty closely. I'm also really worried about STEM. We talked about that in the show that's going to come out next week, or the portfolio 2024 portfolio contest show. It's the second part of the show that comes out on Wednesday. That company might go bankrupt, and I was pretty high on it when it went public, but they've blown through their balance sheet. They had a bunch of cash that they spent, and yeah, I'm worried. So that one I'm particularly interested in seeing if they finally start to do some conversion of some of the deals into money, because they have to. Like, they're in trouble if they don't. What about you?
Yeah, it's funny. Like I think about the ones I'm most interested in kind of fall into buckets for me. So anything that is a relatively large position for me, and again, I say relatively because none of my stocks are really actually large positions in the scope of my portfolio. Um, but I guess, within my stock portfolio, the stocks that are like the largest piece of my, uh, you know, portfolio's value, I'm interested in just because they have the biggest impact on, my total returns, right?
Right.
So yeah, CrowdStrike is one of those for me. Um, and let's see, what's another one that's I'm trying to think. I don't have my portfolio open for me right now, but yeah, CrowdStrike for sure. I think but what's interesting is for CrowdStrike is like, I like when they report because there's nothing, I find that their earnings are just easy.
Mhm.
Like it's all the normal stuff you look for, all the headline numbers, top line, bottom line, margins, cash flow, and then their KPIs are very easy to understand. You know, how many people are using how many products, what's their net dollar retention rate, and then okay, cool. And that one for me is a lot of like, that's why I like the spreadsheet and charting everything. I can kind of see where things are headed. And it's like, if everything's in the right direction, I'm just like, cool, see you in 3 months. Like that's always an easy one for me. Um, in terms of like, I'm just really interested to see, PayPal is one for me. Um, again, I talked about this on the portfolio review that's going to come out next week, but I I'm interested in what management will or won't do with that company. It seems like they have a plan. It seems like they're very honest and open about where the company has fallen short in the past, and I like that honesty and transparency. I like that they started like changing the things they report to be more transparent and just came out and said like we're gonna report this way now because it's clearer. Um, so I I still think PayPal has enormous brand power in terms of, when you think about peer-to-peer payments and also just checking out online, PayPal's the name. So that's what I'm interested in. And then from like a will it ever recover standpoint, obviously Outset Medical, which is my go-to,
Yeah.
my little project here. And then also, here's one that we both there's one that we both own that we both have had really conflicted feelings on, Boston Omaha. So
Yeah. Yeah.
that's
I was
another
wondering
one
if you were going
where,
to bring that one up.
yeah, I'm really interested to see how this quarter shakes out. But also I don't think I'll make any decisions based on solely this quarter. I've determined that I'm going to wait and give them some time to try to see what they're like as a business post one of their CEOs leaving, post shutting down the asset management business. I'm willing to give them some quarters to prove it or not. Um, so those are a couple that pop into my mind. I'm curious. All right, so let me ask you about Boston Omaha because I know that you have feelings about this too. I have a two-part question for you. What do you think the chances are that you still own it after this next earnings report? And what do you think are the chances that you own it still after we get like full year results in February?
So barring the just a complete collapse of the results, which I don't expect is going to happen. I mean, it's a 99% chance that I'll still own it in a few weeks, right? Once we get through earnings. Who knows when they're going to report though?
Yeah, that's true.
Um,
They're one of those annoying ones that just all of a sudden does it.
it's just
No,
the release shows up.
no announcement.
So I mean, things would have to get egregiously bad for me to make that move. But I will say, and I've talked about it before, and just for those that might not be completely aware, so they went through the separation of their two co-CEOs, who had basically founded the business together, took it public, and they were co-CEOs for 8 or 9 years, which is actually a really long time. And one left, and I mean, it didn't seem like there was much acrimony, but it was pretty clear that they had two very different visions about how they wanted to grow the business, scale it up, and allocate capital. And the thing that I'm still trying to figure out is the boy who lived, the CEO that stayed around, is the one that wants to be focused on like the core assets and not be super acquisitive. And honestly, it's the core assets of the things that have underperformed.
And I want to know what that means.
Right.
Do you know what I mean? Like, so all right, so
Yeah.
let's talk
Yeah.
about just the billboard business,
Yeah.
right?
Right.
So if you say I want to focus on the billboard business, but you don't necessarily, unless he's still going to be acquisitive in terms of like bolt-ons to the billboard business. Like I
And
hope
he
they're still going
will.
to be
That's
looking
still gonna
around for
happen.
other ways to add on to the billboard, because otherwise it's just like
Right.
we put up some billboards and got
Yeah.
paid. Like,
But no, the idea is just to take the cash flows from those existing operating businesses and reinvest them back into the businesses to grow. And like I said, the returns, I'm not talking about stock price return, I'm talking about the actual returns of the business, the margins that generate the cash flows, that kind of thing, haven't been great. The stuff that did well, Dreamfinders Homes, right, which they
yeah, their
completely
investing is
exited.
what did well, really.
Yeah, right. Dreamfinders Homes, and then there was the
Sky Harbor.
Sky Harbor, right, and that's still doing pretty well.
But didn't they? I think they're out of both of those stocks now, or do they still own some of Sky Harbor?
I'm pretty sure they still own some Sky Harbor, but they are
They're
completely.
out of Dreamfinder. I know
I
that.
have been for a long time. Actually,
Yeah,
they exited before most of the best part of the run up of the stock price over the past year and a
it's
half or
still
so.
10x for them or something, right? It was still a really
Oh
good
well, yeah. I
return,
mean,
but
they were they were.
yeah,
But the point is, the guy that sounds like he's the one that wants to do more of that kind of entrepreneurial stuff, it's the one that left, right? So, I do think it's going to take more than just a quarter or two to give Peterson a fair shake, right? And I'm willing to be patient and give him an opportunity to see if the way he's trying to grow the business is good. Because if the assets they bought are fine, if they're good and they can get better returns out of them, then this is a very cheap stock trading for below book value. If he's not, they paid too much when they bought those things, and all that goodwill on their books, they're going to have to write it down. And the book value is going to come down and it's going to be a value trap.
Yeah, I mean, that's the thing. It's not like we're gonna get results from them and it's gonna be it I can't imagine there's gonna be an enormous surprise, right? Like, a big surprise would be an acquisition, but you'd know about that before earnings, right? That has to be disclosed. Um, and so, like, I don't expect anything like that. So it feels like it could be, like, marginally better. Like, oh, the cash flows were higher than expected, with the book value per share grew by more than 1%, which is what it's been doing. Um So I don't know. It'll be interesting to see. But yeah, that's certainly I'm in the same boat. I feel like if I'm saying out loud that I'm willing to give them some time to see what the business is like under its current, situation with management, I can't bail after one earnings report. So I gotta give them a few. So I anticipate still owning this business well into 2025 as well, and then maybe reevaluating after that.
Yeah, no, I think that's probably the best approach most investors should take. You should have either already sold or you need to be very patient.
Yeah.
Hey, everybody, we'll be right back, but first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on more than 1,500 stocks. Want to see Netflix's average revenue per member over the past 10 years? FinChat's got it. Do you like to track YouTube's advertising? They've got that too. Want to see how much of Celsius's revenue comes from Costco? You guessed it, they've got it. The breadth of FinChat's segment and KPI data is truly one of a kind. I use FinChat all the time and I love it, especially for checking out the KPIs of all the stocks in my portfolio. To get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every week. From hot stocks such as Nvidia and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and level up your investing skills today.
All right. Well, we've had some comments in the chat from Ken, but here's one related to what we're just talking about. Ken says he might sell Boston Omaha, put the money into Transmedics, bought BOC to be a compounder. I have plenty of boring stocks. Like Jason, I want to give it a couple quarters to make sure my thesis creep is okay. Yeah, I'm kind of in the same boat. So I'm glad you mentioned
Yeah,
thesis.
no, that's right.
I'm glad you mentioned thesis creep, Ken, because I think that's something we can explore a little bit, Jason. So you often hear people say in the world of investing, make sure you have a thesis for every stock you own. And then if the thesis changes, that's a reason to sell. And I understand why people say that. And I think in a lot of instances that's true. But sometimes the thesis can change and it's not a bad thing. In fact, it could be a good
Absolutely.
thing.
Yeah.
And I think about I wasn't paying attention back when Amazon started AWS, just to use an example. But, I'm imagining there was at least someone at the time who was like, an online retailer doing cloud infrastructure? That's weird.
Right.
And I'm sure there's other places where some of these businesses that have a lot of diverse revenue streams first started kind of pivoting out to those other areas. People kind of scratch their head. But if those other areas are generating cash, then that's a good thing to do. So it is kind of thesis creep. Like if you bought Boston Omaha under the understanding that you liked the co-CEOs or that you thought the asset management business was going to be the growth driver for the future, and now all that's different. Yeah, that thesis has changed, and you could call it thesis creep if you're still holding on. I just don't know it's like an automatic sell when the thesis changes.
Yeah, no, I agree with you 100%. I think as a starting point, having a thesis that's needs to be based on developing a good understanding of the business, its opportunities, and its risks. right? Those three things. And part of the opportunities are things that could improve the thesis. Amazon's a good example. You could use Netflix. So just to toss out a couple of massive winners, the business today is very different from the one that you would have bought within the first 5 or so 10 years after it went public. But that's just kind of the optionality that you want to think about, but also thinking about their ability to evolve or get disrupted if they don't. Right? Netflix is a perfect example. Their evolution to streaming. If they didn't make the move in to do that, somebody else was going to, right? So it made sense. An interesting thing about Amazon, though, is part of the thesis for Amazon for really a long time has been their ability to leverage themselves as like the first best customer. So you think about a lot of the things that are some of their highest margin businesses are things that they built the infrastructure out initially for themselves, and they realized that they could sell to third parties for really good margins. So like AWS, they built all of this data infrastructure, right, to run their web commerce business on, and all of their business intelligence stuff that they needed to run, all the computing that they needed for that, but they didn't need it 24/7. So there's an opportunity to sell that bandwidth to other people. So AWS was born. Fulfilled by Amazon is another example. They built all these warehouses, and they're not going to be fully efficient all of the time. There's other small web sellers that have been able to take advantage of that by using Amazon's warehouses to fulfill their own product sales. So that's a high margin piece of business for Amazon to bolt on top of its own. This like sits on top of its own operating leverage and builds on top of it. So part of the Amazon thesis is for a long time has been leveraging their kind of ability to be their first best customer and then scale those things up to sell to other businesses. So that's important.
Yeah, no, for sure. I guess it wasn't a completely out of left field thing. So all right, one last thought.
No. Web services, the cloud business, completely out of left field.
But yeah.
But
what I'm saying is, like,
to adapt and to scale.
No, I'm saying I think it would have been even more out of left field if they just like bought someone else's web business that they weren't using for themselves.
Oh yeah, no,
right?
absolutely.
That's what I meant.
Diversification. Yes.
So here's my last kind of thought about thesis creep, thesis changing as it relates to Boston Oman, then we can move on to something else. I don't know, for me, that my thesis has really changed all that much, because I looked at it as the three kind of core businesses, the billboards, the broadband, and the insurance, as steady, stable, high barrier to entry, at least in the case of the billboards, right? Like, it's not the easiest thing to get into, and it's very fragmented. The broadband's like a lot of CapEx on the front end, but then you have the broadband laid, and you can just make
Very
money.
high margin.
Yeah.
Yeah.
And insurance is insurance, right? So I always just looked at it as like three kind of stable businesses to generate cash and then use that cash to do other great things. And that other great things for me was not necessarily tied to the asset management business. I would have been happy if they just kept using that cash to just make better those three kind of pillars. And I never cared whether they were co-CEOs or not. Like, that wasn't part of the thesis for me. Now they've been not great capital allocators, that was part of the thesis. They were going to use said cash to do good things.
Right.
So maybe that was because of the conflicts that they were having between them. I don't know. So we'll see as we go on. All right. Let's pivot here. All right. So here's a question for you. What's the highest conviction stock you currently own right now that you can't bring yourself to add to purely because of valuation?
So there's two that come to mind quickly. I'll say CrowdStrike first, because I think we both generally agree with that. I really believe that we're going to get better opportunities to buy CrowdStrike than the price right now. But NVIDIA also, And here's why, right? So yes, I think you can make a case. You do the math, you look at the results. It's some 70 something, maybe it's down to 60 something times trailing earnings,
Yeah.
which
High
is
60s, low 70s last time I
yeah,
looked.
yeah. So that's considering how large AI looks like it's going to be, and their share of the market and the dollar numbers that are being thrown, the trillions, of dollar numbers that are being thrown around to be spent on capital, over the next decade, the business could get a lot bigger and generate a lot more profits. But the thing that overhangs it to me is there's a lot of expectations of that business that's baked in. Because again, it is high 60s, and this is a $2.5 trillion company, close to between 2.5 and 3 trillion, whatever the market price is today. That is a big bet that it's going to get bigger, right? Like maybe bigger than anything ever.
Yeah.
And I think that there's a lot of risk in just assuming that that is going to be the case, particularly when we know that this is not a recurring revenue business model where you're a CrowdStrike or like Microsoft has become with their cloud services business, and like AWS is for Amazon, where these are recurring revenues, and it gets harder for companies to pull back. Companies will stop spending. Their CapEx budget will go down 70% from one year to the next if they're not getting a return on a specific kind of investment. And that is a massive risk. That is a massive threat to what's going on with AI. Then NVIDIA is right on the front side of that. So I think it's too many investors have seen the Microsofts of the world that have built these massive recurring revenue streams, and they're forgetting that this is a highly cyclical business that NVIDIA is in, and the chance of a rug pull in the next couple of years is pretty damn high.
It is. I know. I completely understand that, and I agree with you. Like every quarter when they release earnings, I'm always like, are they going to miss analyst estimates? And if they do, are we going to see like a 30% drop because it's priced so for perfection?
Yeah.
But, and then I think it was the last quarter, like the results were great, but like they weren't like quite as great as maybe they had been. And the stock didn't skip a beat. So I was like, all right. Cause usually like if you just miss by, $100,000, like your stock will drop. So, but I think here's the other side of that argument. You mentioned high 60s, low 70s price to earnings. If you look at their 3, 5, 7, and 10-year median price to earnings, which is something I pulled up on YTRA to look at, it is right around 70. So that's the other side of the thought for me is like, well, if over 5, 7, 10 years, it sort of averages this trailing price to earnings, then at least, historically, it's not that expensive.
The challenge with that, though, and the pushback with that is it's one thing for a growth stock to have a very high multiple, and you will see that multiple come down as companies mature. And I don't, this is a $2.5 trillion company.
This isn't like a small cap on its way up.
Right, exactly. So, I mean, so that's the pushback that I have there is if you're going to pay 60 times earnings for a company, then you need to see it double in size.
Yeah.
Right. Or triple in size.
I think so just to contrast that, so there's the two companies in my portfolio that are sort of living right next to NVIDIA in terms of their returns are Arista Networks and Broadcom, which are benefiting from a lot of the same AI-driven tailwinds that NVIDIA is benefiting from. And when I do that same exercise of comparing their current trailing price to earnings ratio versus their 3, 5, 7, and 10-year median, it is 2 to 3 times higher than it historically has been. In fact, I went back and looked. There's on the Motley Fool message boards, there's a yearly stock picking contest that gets run by someone for both the stock advisor service and the rule breaker service. And back in 2022, I think I picked Arista Networks in the beginning of the year, and that stock ended the year down, I don't know, 40, 50%. And now it is up, it's like quadrupled or quintupled since then.
Right.
So those are two companies, Arista and Broadcom, that like I have pretty high conviction in, because I truly do believe that for as long as AI is a thing, they're going to benefit.
Yeah.
But those are ones that I really couldn't bring myself to add to right now, just because I feel like they're never this expensive. But who knows? I mean, if the AI thing is more sustainable than maybe we're giving it credit for, then they could live in this lofty valuation for a while and still, pump out returns for shareholders. So
yeah, I guess when it comes to AI, and we've talked about this before on other shows and live streams and stuff, so I don't want to talk about it a lot, but I want to reiterate, like, where I stand with AI is I have no doubt that in 10 years, in 20 years, AI is going to be a lot more pervasive and a lot bigger and monetized. I have absolutely no doubt about that. Ask me about the next 5 years, and it's so hard to tell what's going to happen, because companies are making really big bets, and they're going to need to see those bets start paying off. And that's where the risk lies in the meantime, in the interim. It's a little bit of like the .com.
Yeah, I was just going to say that. Yep.
Where, yeah, you look 20 years later and the internet is a massive part of essentially everybody on the planet's life to some degree. We use it every day. We work from the internet. So many people, like remote, like everything we buy, like it's healthcare, every part of our lives. But there was a 5-year period from, the peak in 2000, where the market fell 50, 60%, and it took, I don't know, a decade and a half to fully recover. I don't think we're going to see anything like that. And
it's interesting. It's interesting too, because like the biggest winners from the internet started after the internet became the thing, right?
Yes.
So like, if we use 2000 as the starting point, right? Just to pick a number, Netflix was like early 2000s, right?
Yeah.
I mean, I know they were around probably around that time, but when they pivoted to streaming was later, right? So
Right.
like that's maybe the point I'm thinking about. Facebook, 2004, like a lot of the social media apps, a lot of the big winners in like the quote unquote internet age, were not part of that 99, 2000, excitement. So I wonder a lot about like, are the big AI winners that we're going to be talking about 25, 30 years from now going to be coming around in 2028, 2029, in terms of like when they pop onto the scene, because they'll be the ones that sort of see AI implemented and we have like a base foundation of AI and they kind of build off of that.
Right.
And it's hard to tell. I mean, I could see a scenario where NVIDIA and Broadcom and Arista Networks are winners 30 years from now still. And I could also see like maybe one of them is Cisco at the peak that has never recovered, or Microsoft at the peak that took 15 or 20 years to recover. So that's the scary part. So I think for me, it's like I have not sold any NVIDIA. I try not to do that. I haven't added any recently. I don't know, maybe I'll buy a couple shares at some point just because that's not going to make or break me. But
right.
I'm happy to look other places. All right, so let me flip the question then. What's a stock you don't own, but you want to? Like you've looked at the business, you're intrigued by it, you think it's quality, but you just can't pull the trigger because you think it's too expensive right now.
Lamb Research, actually.
Oh, interesting.
Yeah, and I've dealt with this for a long time. With you're gonna have to help me out. My mind is completely blank here. The company that makes the machines, the
ASML.
Yeah, ASML. Thank you. 4 little letters. I just couldn't remember them. But I dealt with this like mental block with ASML for a long time before I just bit the bullet and decided it's time to open a position. And I think I'm going to end up having to do the same thing with Lamb Research. It's just like take out a starter position, bite the bullet to get skin in the game, so that I have exposure. And if the market does create a better price point to add to it, then I'll be ready to add to it. So what about you?
So I have the exact same feeling, and it's hard for me because someone I really respect pushed back at me on this, and that's Costco.
Yeah. Yeah.
I have every belief that it will be a winner moving forward, but it is trading for 50 times earnings right now. I mean, something just absolutely absurd.
And it's always rich.
It's always rich, but it's not that
like
rich.
this. No.
You know,
Yeah.
30, 35 times, I think I could be like, okay, I'll open a starter position. I'll wait for it to pull back to add to it. But yeah, get some skin in the game, follow it more closely, all that stuff. But like, when you start to think like what it would have to do to grow into like a 50 times earnings valuation, it just feels like, I don't know. But then every time I go there, man,
So busy.
It's like-
So busy. Them cards.
and then
are full, too.
what really happens is I just get pissed at myself for like, why didn't I buy this? Why didn't I buy this in 2020 when I was like excited about everything? Like I bought
Yeah.
so many things
Yeah.
when I was brand new that I lucked out. Like I bought Apple because I like Apple products, and I did it at like, it was trading for like, I don't know, 20 times sales or 20 times earnings at that point or something like that. I didn't know what that meant. And I'm like, why the hell didn't I buy Costco in 2020? That would have been a smart move. I'm sure it's up since then.
Nobody's perfect, Jeff. Especially you.
What do you mean, especially me? What does that mean? All right. Anyway, we're going to move on.
Hey, everybody, we'll be right back, but first, a word from our sponsors. Earlier in the show, you heard us talk about investing platform public.com. That's where you can trade options with no commissions or per contract fees. And you get a rebate of up to 18 cents per contract traded. NerdWallet recently gave Public 5 out of 5 stars for options trading. If you want to see why, go to public.com and start getting a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carries significant risk. Full disclosures and podcast description. U.S. members only.
All right. I got a fun game for you. Ready?
Okay. Yeah.
I'm going to give you the name of the 5 biggest losers that are currently in my portfolio. And you have to pick one that you have to buy.
Oh. I don't like this game.
And then
Okay,
I want
let's
you
do
to
it.
open your portfolio while we're talking, and I want you to play the game with me. All right,
Okay.
here are my bottom 5. I think in order of worst to best. Outset Medical.
I
No
was actually about to
surprise.
say that out loud.
Redfin,
Okay.
Etsy,
Okay.
Roku,
Okay.
and DigitalOcean. And I know you own some of these already, so this might be not as fun, but
Have owned. Yeah. So, all right. So I'm going to start with the ones that I won't buy. Like definitely won't buy. DigitalOcean, we've talked about that one before, and I kind of agree with you that like the downside there seems to be that their focus on small customers. Aren't they trying to change that a little bit and start move a little bit up market?
well, they're going to have to, right? This was always part of the thing for me ever since I found out about
Yeah.
the company a couple years ago. Like if you're going to cater to small customers, that's great. But what happens when they grow,
Yeah.
right?
Yeah.
You're either going to be like, hey, thanks for being here. Go to AWS, or you're going to have to
Right.
grow with them without losing the ability to cater to the new small customers.
Right.
So yeah, I think they're trying to grow up with their like customer
Yeah.
base.
Well, and I mean, you could look at Shopify. They've been very successful with that. A number of companies like Allbirds and what's the company that makes the medical industry people clothing, healthcare workers.
Oh, Figs.
Figs, right? Make scrubs and that kind of stuff. When they call them like Shopify IPOs, companies that like they started off selling on Shopify on the platform, and that have gotten big enough to be publicly traded companies. And they have part of their business that actually provides like omni-channel, the e-commerce part for like big brands, like
Right.
multinational brands. So, and they started very much focused on SMB. So there's a path forward for that, but I don't know. It just seems like economy of scale are a challenge when you're just serving small customers.
I've thought so many times about if I should sell this one or not. But when I go,
Yeah.
every time I do that, I go and look at the actual results and they're doing okay.
Yeah.
Like all of the metrics that you'd want to watch are kind of heading in the right direction. I mean, they're seeing the same slowdown everyone's seeing and all that kind of stuff. Like nothing's happening. So I have to think that my desire to sell is because it's just not done well as a stock for me.
Yeah. Right.
Um,
Yeah.
but yeah, I mean, they have challenges. It's not a high conviction. I could see them getting acquired. I could see them, just not being able to grow with their customers and then just losing them. I don't know. But
Yeah. I love that this business exists. I just don't see any really durable competitive advantages that make it attractive to me to own. So that's that. Roku, you and I've talked about. I don't think it's a super sticky product. I think they obviously have fans that love the product, but who makes the bike? The
Peloton,
Peloton? They've also got fans, and that company
yeah.
sucks.
I can't believe how
So
badly that stock is done. Like, I
yeah.
mean, I get that they was like blown up during the pandemic, but they just cannot get their act together.
Yeah, and but my point is like I don't see like again they don't have economies of scale that I think are really valuable. They've built a pretty good little business and it's a good business, but I don't think it necessarily is going to translate to being a good stock to own because they're competing against some really big players at scale that can do a lot of the stuff they do and like as a loss leader, like Amazon is a good example, right? They just want people in their ecosystem and they want to make money, but it's more important for them to grow their ecosystem with content, right?
Mhm.
So I just don't think Roku really is built to take any outsized portion of the market and maintain it. Like I don't feel that it is. Outset we've talked about. I'm not ready to buy more because I need to see more from them.
All right, but you have to pick one.
I mean, there's one left. No, it's two left. Etsy. Screw Etsy. They make me mad.
I know you're going to go with Redfin
Yeah,
because you like Redfin.
I do, but the problem here's the problem with buying Redfin right now. They make their money selling houses. There's no houses to sell.
Yeah.
That's a tough time right now for them. I think over the long term, it's going to work out well. I haven't sold any. Yeah, maybe now is the time to buy Redfin. I'll just go with Redfin because Etsy, like I said, they make me mad. What about you of these five? And then we'll do mine.
Oh, if I had to keep only one of these five, I would probably keep. I would probably keep Redfin too, only because I think they have the highest chance of turning things around. But I think it's going to take a really long time. Like I think like a decade.
The dynamics of the residential real estate market with existing inventory is a mess. It's a mess.
I also think Outset's going to do it. I think they're going to turn things around. So I would have to go between them. If I had to sell one of these right now, like if you told me like right now you just have to hit the sell button.
Etsy. You'd sell Etsy.
Yeah. They drive me crazy. Their management annoys me, but I've ranted about them enough. All right, give me your bottom five. I want to
Is
play
that
the
Etsy
game.
or is that Pinterest? Right to win?
That's Etsy.
Etsy. It is. I thought so. Yeah. Eek. Yeah. Okay. So here's mine. 23andMe, TDOC, Curiosity Stream, YTRA Online, the Russian search engine, and Solid Power, the solid state battery startup.
Okay, so I don't know, other than TDOC, I don't know much about any of these companies. I know a little bit about Curiosity Stream. I know what 23andMe does.
Yeah, a lack of knowledge has never stopped you from having an opinion about it.
Oh, no. Oh, I have an opinion. This is easy for me. If I had to pick one of these to buy, I would pick TDOC because I actually do think like telemedicine is really a thing.
Mm-hmm.
I think as it grows, they have as good of a chance as anyone to sort of capture market because I know there's a lot of competitors out there, but I can't name a single one. And
Microsoft.
They do telehealth?
A little bit. Yeah, a little bit.
Okay, but like a pure play telehealth provider, I can't name another one. Now that does not mean
They're
They
not
won't
public.
just
They're mostly
right.
privately held or owned by private equity or that kind
So
of thing.
that doesn't mean that like Teledoc's going to win, right? They could die. It could be
Yeah.
death by 1,000 paper cuts for them.
Right.
But if I had to pick one, I would pick Teladoc because and also the stock's just been beat to hell. Like I feel like if you took a flyer on it now and held it for a decade, you'd be in much better shape than what I did, which was buy it in 2021, either right before or right around the time they acquired
Livongo Health.
Livongo. Yeah.
Within 18 months, they had written down
Yeah.
all of that goodwill too. We
Right.
talked about that on the episode
With
last week.
Jason. Yeah, with Jason Moses.
Jason Moses.
With greater Jason. With
Yeah,
gooder
Jason the Greater.
Jason
Yeah.
the Greater.
Yeah.
Of these 5, the one that I would not buy under any circumstances, just based on absolutely no knowledge, is the Russian whatever.
Yeah. YTRA Online.
Yeah, I don't want anything to do with that.
Yeah. That was a loser before Russia invaded Ukraine.
Tell me a little bit about the solid state one, because the only solid state battery company I'm aware of, and I don't even have a deep knowledge of it, is QuantumScape, which just had big news this week. But tell me more about this solid state battery company.
So Solid Power and QuantumScape actually went public at somewhat similar times. Solid Power, I'm pretty sure, was a SPAC. Came out of a lab in somewhere in the Midwest, Colorado, maybe. They've got some big automotive partners, BMW, Ford. They're taking a different approach to what they're doing. Like licensing and then like manufacturing the separator material, or maybe it's the cathode, the anode material. I can't remember. But they're taking a little bit different approach, and they're behind. They've fallen behind. It seems like. And here's the thing: it's not just these 2 companies, and one's going to be a winner. It's possible neither of them win because they're still pre-revenue at this point. Neither has launched a commercial product, and there's tons of other players that are working on solid state too. But the battery, I don't know, it's probably $1.50 a share now. It's just not done well because they've lost some ground and they haven't moved closer to commercialization as quickly as expected. So yeah.
All right. Why do you still own these 5?
Because I am glacial when it comes to selling, I guess is the best way to put it.
I guess why I'm asking the question is, I know you've sold other stocks since the time you've owned these.
Yeah.
But these seem to be like legit losers. And you've sold other stocks that are like okay stocks, or ones that you're just sort of kind of soured on. Like, I guess the one that I'm most curious about is like Curiosity Stream.
They're
Like,
paying a dividend now.
are they really?
It's the stock price is like, I got to look it up now because I can't remember what is the stock price. $1.22 a share. And the dividend was like, I don't know, 20 cents or something. It's like, where are you guys getting this money from?
Yeah,
so it's
they have
really
enough money to pay a dividend?
Not really. No, not sustainably. So, but
I'm not trying to push you to sell. I'm just
no. I know. Well, here's
curious.
why. I will tell you exactly why. I'm doing the math right now. That's why I'm looking away from the screen. These 5 companies combined make up 0.1% of my portfolio.
All right, so that does make sense. But I guess it does and it doesn't, right? So to me,
I don't know if that's right.
They're starter position level in terms of how much you put into them, right? So let's just look at them as starter positions, even if they're not.
Right.
Do you think these 5 companies have potential? Do you think Curiosity Stream turns it around?
So I think TDOC and Solid Power, there's still potential there. I think Solid Power
makes sense to me.
It's a couple bucks a share. It's still a startup. The EV industry is in a mess.
That one makes sense to me.
Yeah.
I totally understand, like, maybe this
Right.
turns into something. It's not a lot. Let's just wait and see.
Right. So
I don't understand the other ones.
Of those, that's it. TDOC, yeah, we've talked about that. But 23andMe, I bought it with the idea that all of this data would be valuable, would be really valuable IP, and their ability to use it for studies and for research would be really valuable. They haven't been able to monetize it worth a damn. So I have $144 invested in it now. So like that's like it's down 96%, 97, whatever. Like it's down a lot. Curiosity Stream, I have more because I invested more.
But you have that sweet ass dividend payment now, so
it's making all the difference. All the difference. So the Curiosity Stream, I don't know. I really should just sell it. I really should. Honestly.
All right, so I'm gonna wrap us up by letting everyone know something. So a lot of some people watch this are watching this live. Some people listen on our podcast feed. Some people will watch this on YouTube later. Spotify, if you're a Spotify listener, they changed the app where you can now leave comments on episodes, and we can reply to them. So you could always answer the little question at the end, but there was no way for me or us to reply. I would just post it. So if you're listening on Spotify, as soon as this episode ends, I want you to engage with that feature and tell Jason which of his 5 stocks he should sell.
I like that. I really like that.
And you could do it with me as well if you want to play fairly. But
before we hop off, though, Dave from the Investing for Beginners podcast hopped on here, had a good comment here. Buy slow, sell slower. That's fantastic. I like that way of thinking. Sina Hasuna joining us too. Sina, thank you for hopping on. Ken, as always, appreciate you jumping on too. So everybody else that hopped on, checked us out on the live stream, very much appreciated. This is fun. It's one of the highlights of the month for us to be able to do this. We do this every week. It's fun to do it with other people watching and chiming in too. So we definitely appreciate that. Jeff, any last words?
No, just wanted to get that plug in for the new Spotify feature. If you're not listening on Spotify, if you're on Apple Podcasts, you can help us out by giving us 5-star rating and giving us a review. We haven't had a review in for a while. I think it's time to shame our Apple listeners into giving us reviews again.
All right. Apple users. I mean, you're our people. We're me and Jeff both. We're also Apple users.
Yeah. Help us out.
Shame on you. Except for those of you that have reviewed us. Good job, you.
Yeah. You guys are
the rest
the best.
of you. Get it together.
All right. I have nothing to add, Jason.
Thank you, Charlie. Appreciate it. Please, those 5 stocks. I'd love for you guys to weigh in Spotify like Jeff asked for. So I shall read us out. As always, Jeff and I love to share our thoughts about these hard questions about investing. Weigh in on your questions for us. Give our thoughts and our answers. They are our answers. You can try them on. You can borrow them. But you need to make those answers your own. Find your own answers if ours don't fit. You can do it. I believe in you. Have a great weekend, everybody. We'll see you next time. Jeff, I'll see you next time too.
See you next time.